Hello and welcome to Market Domination. I'm Jared Blikre and live from our New York headquarters. There's just an hour to go until the closing bell and stocks are, well, they are green, but we have seen a reversal of fortune here. Let me just show you what's happening in the Dow here. It's up 0.2%, 300 points, and we started out in the red territory in the first hour. Mostly, we have climbed down into the green here, and we are now by the highs of the session. NASDAQ, on the other hand, started out really strong. We saw tech stocks, especially chip stocks, really surging in the early goings, but those gains have been given back. It is just about flat right now. S&P 500 just up marginally, kind of looking like the NASDAQ more than the industrials, more than the Dow Jones Industrials right now. And here's the small caps. They are kind of in sync with the Dow, and we can see that they are up 1%, and that is some nice outperformance on the first day of the year. We'll get to the sector action, which has really changed today, but first I want to check in on the bond market. We got the 10-year T-note yield. Bond market just closing, by the way, that is down 2 basis points to 4.19%. 30-year down or up 2 basis points to 4.86%, and the US dollar index just barely green there, up about 12 basis points. And here's the sector action. We started out with tech as the only outperformer. XLK was up 1%. Here it is. It's only up about 1/3% right now. Energy has taken the lead, followed by industrials, materials, utilities, all of those up more than 1%. And then we got these mega cap sectors down here, consumer discretionary and communication services. Those are in the red, and not surprisingly, when we take a look at the NASDAQ, we're seeing some red in some of the mega cap spaces. Microsoft down 2%, Tesla also down 2%, Amazon almost right there. And I want to drill into the semiconductors. This is a nice looking board right here. A lot of dark green. Micron up 10, ASML almost up a similar amount, Nvidia up 1%, though off of the highs. But here's what's slowing down tech. This was red to begin the day. Now it's dark red in a lot of spaces, and we're just seeing software really kind of leak into some of those tech gains, and that's why tech has given back most of those for the day. Want to check in on the Dow as well. Industrial surging here. Caterpillar up 4.5%, but banks looking good too. Goldman Sachs up nearly 4%. Said energy was the leading trade. That was up, Chevron up about 2% here. And just taking a quick peek at the transports, that's a lot of green. So the Dow transports looking a lot better than the Dow Industrials. Uber's up 1%, so is UPS and FedEx, and some of the transports like ODFL up about 2%. So let's dig into the market right now, which is kind of wavering into the close to start out 2026, but investors are uncertain as they want to see whether stocks can maintain the blockbuster momentum that we've seen the last 3 years. And joining me now is Mark Gibbons, Gibbons Capital President and Chief Investment Officer. Mark, thanks for joining us. Let's start big picture. Your base case on stocks in 2026 is, quote, constructive. That's based on taxes, the Fed, productivity. Break it down for us.
Yeah, that's right. I mean, as we come into the year, economy looks like it's going to be growing about 3% next year. So obviously good there. We do have inflation coming down, and we have a Federal Reserve, which is easing. So all a great backdrop on the macro front. And then when you look at earnings, we're looking at mid, double-digit earnings growth, like as far as the S&P 500 is concerned. So everything looks pretty good.
And talk to me a little bit more in depth about the taxes. You're talking about bigger refunds, lower tax burdens, et cetera. Break that down a little bit more for us.
Yeah, so the average taxpayer looks like they're going to get more money back on this refund and pay less in taxes. So when you combine those two things, that's great for the economy and allows for more spending to kind of run through it. So the consumer is looking pretty good right now, definitely stable. We do have the K-shaped economy, but the high end continues to hold it up.
Let's talk about some tickers here. We can talk about the Mag 7, the S&P 493. We've talked about the K-shaped consumer, but we also kind of have a K-shaped stock market at times. The concentration that we've seen in the stock market among some of the AI trade and the Mag 7 names, not as great as it has been in the past, but it's still a lingering concern. How do you see that shaping up in the new year?
Yeah, so I expect tech to have another good year, but I also expect the broader market to have a good year. So I think there's going to be more participation. I don't think it has to be one or the other. So you can see other sectors perform well too, but I think tech, again, has a good year. It's set up for some heavy AI spending to continue.
Okay, so the AI spending was a huge thing, and the AI spending has also been concomitant, excuse me, with the earnings growth that we've seen in Nvidia and also some of the hyperscalers. How do you see that playing out? Can the growth continue there?
It certainly can. Demand, figures keep showing quite a bit of growth from companies like Nvidia, Broadcom, and others. So yeah, it can certainly continue, and we don't see this train slowing down, honestly, for several years. So the build out continues and will continue in 2026, and everything on that front looks pretty solid.
Well, let's talk about some headwinds then, maybe. I'm wondering if labor might be one of those. We've seen some soft patches in the data recently, and then we didn't have data for a few months, but all things appear to be on schedule now. We're going to get the monthly report next week on schedule. So what does labor look like to you? What do you expect from the December payrolls from the BLS?
Well, there's certainly been some softness in the labor market we've seen in recent months, but it doesn't look like it's falling off a cliff. It's holding up in there. Maybe we're growing at, let's say, 50,000 jobs per month instead of, it wasn't so long ago, we were growing around 150,000 jobs per month. But overall, I think the labor market's pretty good. I think some of the softness we are seeing is attributable to AI and maybe some other small factors. But I think, generally speaking, it's going to hang in there, but it's also going to be soft enough to allow the Federal Reserve to cut interest rates.
How many times do you think this year?
Gosh, probably in the 2 to 4 range, maybe even more likely 2 to 3. But I'm expecting several rate cuts. So I think the Fed itself, as far as the dot plot's concerned, it was looking at about 1 rate cut, but I think they're going to have to cut a bit more. So I think we're looking at 2 or 3.
Let's talk about some individual names that you're looking at, and we can start with the big one, Nvidia. What does it do?
Has another good year. The AI juggernaut continues, and it continues to perform. So when you want a solid stock that's the best one in the room and the best one on this AI trade, it's Nvidia. And the PE multiple on Nvidia has come in quite a bit. So we're looking at mid to high 20s on the PE on a forward basis. So it's looking relatively cheap. It has been put down. It's still 10% below its high, but it looks pretty good.
And what about Broadcom? Now, this is a stock that on the trailing year, let's take a look. It was up about 50% last year. Very nice return. What do you think it does, and what are some of the factors that kind of drive it this year?
Well, I think the main factor is demand for custom silicon, and it continues to prove to be correct. So it's down quite a bit from its high. It's down around, 15 or so percent from its high. So a lot of room to run. And I think it will. Again, this AI theme will continue. I don't expect it to be the only thing kind of going out there in the markets. Other sectors can perform well, but again, really like Broadcom here.
Okay, and the final one from your list is JP Morgan. Maybe we've seen the value trade kind of surge at various times. We closed the year looking pretty good. What do you like about JP Morgan? Is it financials or is it just value overall?
So there are, a few components to it. So net interest income looks like it's going to do pretty well with the spread between short and long rates increasing. So definitely like the net income story there. Also capital markets activity. So expect some more M&A activity, IPO activity, and then the overall economy itself. So banks are a bellwether for economic growth, and expecting around 3% economic growth in 2026 should perform well.
Sounds good. Thanks for stopping by here, Mark.
Thanks for having me.
And coming up, we're looking at the energy sector, which also has ridden the AI wave a little bit higher. What you need to know for your portfolio, that's up next. It is a new year, and to kick it off in style, the Consumer Electronics Show will be one of the biggest tech conferences. CES is kicking off on January 6th under the bright lights of Las Vegas, and tech editor Dan Howley is here with what to expect. Dan, tell us.
Yeah, Jared, there's going to be a number of big announcements out of this year's show. The first, obviously, will probably, and biggest, be out of Nvidia. They're hosting their own press event on January 5th. CEO Jensen Huang will take the stage. He did it last year as well. They announced a number of new products, a new chip for a smaller bite-sized desktop AI computer, as well as a number of different software innovations that they've really been pushing as of late. They also brought out their kind of digital army of robots. It was basically a video recording, and then a little tiny robot, care of Star Wars, took the stage alongside of him. Outside of Nvidia, we're also expecting to see AMD host their own press event with CEO Lisa Su. We'll see Intel and Qualcomm both host press events as well related to their respective chips. And then overall, we should see a ton of AI. I mean, the chips themselves are obviously enough to say that AI is going to dominate, but you can expect to see a lot of robots, a lot of smart home devices. You could even see some wearables that are AI powered. And those usually, so far we haven't seen anything too interesting as far as AI powered wearables outside of maybe, the intelligence built into smart glasses or smartwatches. There's never been a dedicated device that's really taken off. OpenAI is supposedly working on one. Don't expect it at CES. And then finally, autos. Autos have been a big part of CES as of late. They continue to do so, and we'll likely see things ranging from flying cars to different types of boats. We know that there'll be some major automakers like Hyundai on hand, Sony and Honda. Their Afeela vehicle will be there as well. And so it's going to be a jam-packed show. But again, I think the big takeaway is going to be from Nvidia. They're the hottest company on the market right now, and what they're doing in AI, as well as AI from the rest of the companies at the show.
Dan, we got about 30 seconds. So I'm just going to ask you real quickly, any surprises over the last few weeks that have jumped into your attention span that might kind of give us a hint of what 2026 has in store for us in tech?
Yeah, I mean, the Nvidia Grok kind of licensing
Yes.
deal, non-exclusive licensing deal. I think it was estimated $20 billion. That was really interesting. And it just kind of shows where Nvidia sees its future at this point, making these kinds of investments in new types of chip technologies or different types of chip technologies to really hold on to the lead that it has. I think we're going to continue to see these kinds of not necessarily acquisitions, but licensing agreements. We'll hire some executives from a company, things along those lines. They really kind of became popular in 2025, and I think we'll continue to see them through 2026. It's a way for companies to kind of avoid the scrutiny of acquiring a company, taking it over entirely, while still getting some of that know-how and IP.
All right, Dan, appreciate it. We'll see you soon. And despite a year of shifts in global policies and geopolitical strains, the energy sector was able to power up gains for 2025. So to see what's in store for 2026, we welcome in Anthony Crowdell, Mizuho America's Managing Director and Senior Analyst. So lay it out for us here. We can talk about energy, especially utilities. We know there's high demand, and utilities used to be boring, but they weren't boring last year. So give us the rundown for 2026.
Yeah, you bet, Jared. Yeah, definitely not boring last year. We continue to be excited, give this level of excitement. I think a lot of it's driven to our previous guest here that really spoke highly of the AI trade is still going to drive the market. Even with all that interest going around in our sector, we're calling for the utility sector, the regulated utility sector, to underperform the market, given we have a lot of headwinds, particularly with affordability. So we think, Mizuho's economists are predicting a very strong year for the S&P. And we think investors will look for those riskier assets and leave this, what used to be a very boring, widows and orphans sector behind. And we're looking for underperformance in 2026.
Can you talk to us about some of those headwinds? Is that some of the increased demand leaking over into the consumer sector and pressuring prices there, resulting in political backlash? What exactly is going to go on, do you think?
Yeah, Jared, it's a combination of all of that. If you just think, I think a lot of the backlash, we're spending record levels of capital, right? If you just think of how customer bills are set up at home, your utility bill is based on a cost of service formula, which is kind of rate based, or the amount utilities have invested, times an equity ratio, times a return on equity. The more utilities spend, the more they're able to earn, the more your customer bill is. The sector's spending at record levels to meet this demand, to replace old generation. It's a whole mix of what's really driving these higher bills. It's not just data centers, there's also retiring old equipment, making more reinforced equipment, resiliency going on. You roll all of that up and now try to put that in customer bills when the backdrop across the country is kind of affordability. That's a huge headwind. So as these utilities are spending more and more, they have to go into the regulator and ask for more and more money or higher rate increases. And we think that's going to be a really big headwind for this space. We have some names we think can navigate it, but we're really paying attention to the regulatory filings utilities are making. But understand, customers are going to pay a lot, and regulators are going to pay a lot more, and regulators are going to grant these rate increases as reliability probably trumps all the issues.
And I'd be interested to know, it's going to be a huge election year. Does any of that, do politics play into your outlook at all, or is that something that you can just overlook and kind of consider the other factors?
No, if we think about 2025, we had two gubernatorial elections. We had New Jersey and Virginia, and anybody on the East Coast here by New Jersey, utility bills became a huge issue in that campaign. I think we've seen several stories in local papers that utility bills are the new price of eggs. Whereas maybe 2 years ago, people were arguing over the price of eggs. Now it's these utility bills. Fast forward to 2026, we're in line for 36 gubernatorial elections. So it's going to really play into it. No politician ever lost a vote from beating up on the local utility. And we think that that's going to be a real drumbeat that you keep hearing of these bills are getting higher and higher. And the challenger or the challenger running for election is going to say, we're going to be able to fix these utility bills, which is just, not the case. But that pressure and that political pressure will weigh down on the sector.
You mentioned some names, that you have some names before. Any that you could share with us and tell us why you like them?
Yeah, I think if I gave you our top two ideas, again, we're thinking the sector underperforms. The only time we think the utility sector would outperform in 2026 is we saw a huge market correction. And if people then flock to defense in our space, we think there's several names that are really be defensive. But for a sector that's going to underperform, we're thinking, top three ideas. Number one is Con Edison, local utility, ticker ED, buy rated. We like Con Edison. They just settled a 3-year rate plan. We expect that to get approved without modification sometime in January and February. And that really paves the way for 3 years of their regulatory certainty. Now, some investors push back and say, hey, we have a new mayor in New York City. With the Democratic Socialist, I think is how he described himself. And maybe I don't want to be involved in utilities here, but utilities are regulated at the state level, not the city level. And New York City is just an intervener. And really the biggest impact a mayor could make in New York City to Con Ed is through property taxes. And property taxes are a full pass through to customer bills. So number one, Con Ed, we're going to get regulatory certainty, hopefully January and February. And that's 3 years of a real boring stock that's trading at a 3% PE discount, but also important, Baa1 balance sheet really strong. Second idea we like a lot, Ameren, based out of St. Louis, utility has properties in Missouri and in Illinois, and it trades at a 5-6% PE premium. We think it stretches over that 10% mark premium. Again, not many rate cases going on in 2026. Utility management that goes in there asks, modest rate increases, very, frequent, 18 to 24 months. And that avoids that really big ask, which really gets us concerned. And that's a name we think also investors would want to enjoy.
All right, appreciate that. It sounds like it's going to be maybe a year of defense for utilities, which is the classical role, instead of that hot AI trade. Appreciate you stopping by here, Anthony.
You bet, Jared. Thank you so much.
And we're getting the pulse of the retail investor and the stocks they're watching in 2026. The list is an extension of the big trends from last year, from artificial intelligence to crypto. Caleb Silver, Investopedia editor-in-chief, joined me earlier and broke down the list and what investors need to think about when investing in these names. Take a listen.
Let's start with Oracle, the poster child of the AI overspend, potentially a lot of doubts going into the end of the year about Oracle's spend on AI, about its investments in OpenAI, but also a lot of concerns about its debt. Now, there's a lot of other companies to be concerned about. Oracle is a very strong company with a big market cap and pretty solid leadership. That said, this is the one stock that a lot of investors were focused on towards the end of the year. Is this going to be sustainable? Is the spend on AI going to pay off? I'm watching that pretty closely. Constellation has been doing very well as the de facto poster child power generator for the AI build out of all these data centers. So it's been an extremely strong stock. Is that demand going to continue? Constellation being among the biggest of the power generators providing to this sector. I'm watching that stock closely to see if that demand continues and if the enthusiasm among investors for these power stocks that are supposed to be powering the AI build out remains. And also Robinhood, one of the strongest stocks of 2025. That is a huge risk play, but Robinhood has been making some very substantial moves over the last couple of years. The most recent move is this move into sports betting. And you and I have talked about this, this slamming together of sports betting, probability betting, stock trading, day trading, crypto, DeFi, and 24/6 trading, tokenization. All this is coming together very quickly. Robinhood is right in the middle of it. Let's see if the investor enthusiasm for Robinhood continues as well. And then you just mentioned Berkshire Hathaway. It's the beginning of a brand new era. The beginning of a brand new era. The Buffett premium may have disappeared. The stock was up 10% last year, but the market was up much better than that. We'll see what happens with that huge cash trove. And we know Buffett's not going to just disappear and start playing
he's still chairman.
Bridge. He's still chairman. He's going to be consulted on everything, but this is Greg Abel's company now going forward. I want to watch Berkshire Hathaway. So many people have become millionaires and billionaires with that stock over the past 50 years.
One more here. I don't think we got to strategy. So this is a stock that was kind of bucking the trend of all these other winners here. So, and this is a stock that was just, I'm going to show, that's a 1-year chart. Let's show the 5-year chart there. And you can see this is, it's looking kind of bubbly there in 2025. What do you think this portends for the next year?
Well, remember, strategy was MicroStrategy, but then Michael Saylor said, I'm going to go all in on becoming a Bitcoin treasury. The problem with becoming a Bitcoin treasury is that that's your balance sheet. And even if Bitcoin is down, what was Bitcoin down some 20-25% towards the end of this year, end of 2025, if you're a Bitcoin treasury, that means your balance sheet is heavily dependent on the fluctuations in that coin, and you're being valued off of what might happen. And that's why you see that stock being down much worse than Bitcoin itself. That seemed like a good idea at the time as Bitcoin was soaring to $120,000 per coin. But as soon as that coin starts falling and as soon as there's doubts around, the strength of the momentum with Bitcoin, which seemed to fall apart towards the end of 2025, you're going to see companies that are relying heavily on putting Bitcoin in its treasury. And that includes Tesla too, by the way. You're going to see them suffer even worse than the price of the coin itself.
Coming up today marks Berkshire Hathaway's first day without Warren Buffett as CEO. We've got the investor playbook for the stock, plus a broader look at the insurance business. That is a wrap on the first day of trading for 2026. Let's take a look at the market action. And it was a reversal of fortune for the NASDAQ and the Dow today. Here's a NASDAQ composite. You can see this is the intraday price action. Started out in the green, ended just slightly in the red. Here's a Dow. Started out mostly in the red during the first hour, ended at the green, in the green, for pretty much at the highs of the day, up about 0.2% or 319 points. Here's the S&P 500. Did produce a small gain, but you can see it was much higher earlier in the day. So we'll have to see what the new year brings. But for now, the Russell 2000 also looking strong. Small caps up about 1% today, according to that index. And let's check out the sector action because we saw a reversal here. Tech was leading earlier on. And here we see at the bottom left, it's up 0.2%. But what stole the top spot is energy. That's up 2.1%, followed by industrials, materials, utilities. All of those up more than 1%. And then we got the two mega cap sectors, two of the three. One is tech, but communication services and consumer discretionary, where we have Amazon, Tesla, and then Meta and Alphabet there. Those were down. Those were down about 7 to 0.9%. And you can see that's reflected in the NASDAQ 100, and especially some of these mega caps here where we got the mixed board today. Alphabet was up 0.7%, but as I said, Meta is also part of that communication services group, down 1.5%. Nvidia in tech up 1%, so is Broadcom, but Apple was down, and then Amazon and Tesla, both of those in consumer discretionary, two of the biggest weights, those were down about 1-2%. And checking in on the semiconductors, they were strong early on. They finished the day strong. Micron up 10%, AMD over 4%, ASML almost 9%, along with Lam Research. So strong day for them, but Software, a different story. A lot of red here, dark red too. Salesforce down 4%, Intuit down 5%, and a bunch of these others down about 4 or 5% as well. Oracle, though, a slight bright spot, up about 0.4%. I'm going to leave us off on the Dow, and we can see some of the industrial and energy names here looking real nice, along with finance. JP Morgan up 1%, Goldman Sachs up 4%, Caterpillar up 4.5%, and Chevron up 2%. And Berkshire Hathaway is entering a new chapter in 2026 as Warren Buffett officially hands the reins to longtime lieutenant Greg Abel. For more, we're bringing in Yahoo Finance senior markets reporter Ines Ferre with this week's Investor Playbook. Ines.
Jared, and in this week's Investor Playbook, we took a look at Berkshire Hathaway, and Warren Buffett really leaves this company with some stunning returns. If an investor put money into Berkshire Hathaway back in 1965, when Warren Buffett took the helm, they would have made a realized return of 6,100%. That's far above the S&P 500's approximately 46,000 return, including dividends. The growing question now that Greg Abel is at the helm is, what will Berkshire Hathaway do with its cash pile of $380 billion? You have the AI boom that's sweeping over Wall Street. You have high valuations. So the question is, what do they acquire? Analysts anticipate that investors may start to clamor for a dividend if they're not spending that cash. You had on Yahoo Finance, Jonathan Boyer, president of Boyer Research, he's a shareholder. He said that as a shareholder, the amount of cash that Berkshire has is excessive, and he would like to see a dividend, because if Warren Buffett, who is an excellent stock picker, is gone, then he would like to see the company pay a dividend. Now, while Buffett and also the late Charlie Munger, they were famous for having a sort of hands-off, decentralized sort of approach to the company, Greg Abel is seen as somebody that may be more hands-on. So there is this expectation that perhaps there would be some consolidation, some cutting of fat. He may also be leaning into some of his areas that he's come from of expertise with respect to energy, with respect to industrials, especially as you have this AI boom that's happening. But one thing is for sure, Buffett's pearls of wisdom, his advice on investing, buying wonderful companies at a fair price, that is something that is timeless. And analysts are saying that that is something that is sage advice for investors during any period.
Yeah, well, thank you for that report, Ines. And as Berkshire transitions into the post-Buffett era, insurance stocks are in focus and falling out of favor, even as some of the best operators are trading at valuations investors don't usually get. My next guest says insurance is a cyclical business that isn't just about putting money to work, but it is also about returning capital to shareholders. For more, we're bringing in Joshua Shanker, senior insurance analyst of BofA Securities. So thank you for joining us here today, Josh. I want to call the Wi-Fi interactive. I have your insurance coverage universe along with some of the one-year performance, and it's kind of a mixed board here. If I sort by performance, equal weight, you can see you got about almost 50% green, 50% red, a little more green there. But what separates some of these from the pack, and what are you looking for in 2026?
Well, there's a number of things going on. First of all, the sector's pretty wide. There's life insurance and there's property and casualty insurance, which are really marching to two different drummers overall. The pricing for insurance is generally down, or at least not keeping up with loss costs. And so the fundamentals of the industry on the property and casualty side aren't necessarily working in the way the market might like. Now, when prices are down and companies aren't making as much money, they can return capital to shareholders. And we like those kind of names. On the other side, you point to the life names. A lot of them are up for the year. They benefit from a higher interest rate environment. And as we move into rate cuts in 2026, that might be a risk to those stocks. And so there's been different stocks behaving differently. But overall, we think that the cyclicality of the insurance industry, you want to be owning the stocks that perform the best when the getting is good and also know when it's time to hand those chips back. And so you have names like Progressive and Renaissance Re that are returning copious amounts of money to shareholders and following their cyclical nature. And we think that investors are getting rewarded with high dividends, high buybacks at attractive valuations. And those would be the two stocks that we think are most contrarian, but have the most potential upside over an extended period of time.
Well, thanks for those picks there. Let's talk about mergers and acquisitions. What does the field look like, especially for insurance stocks coming into the new year? The interest rate environment is going to be important there, but also just generally, how important is deal making going to be for some of these carriers?
I think there's two things to consider. One, on December 10th, there was a news story that came out that perhaps Chubb was interested in buying AIG. The stocks went up on that day, believing that M&A fever would take over the group. Does it happen? I don't know about that deal in particular. It seems like it makes sense depending on what the valuation is and whatnot. But both sides have to claim that that's not actually going to happen. But overall, when you have a lot of capital and you can't earn the same kinds of returns that you would otherwise, you can return capital through buybacks and dividends, or you can do a M&A transaction. We would expect to see more M&A. The problem is that as these businesses get bigger and bigger, the deal sizes get chunkier and chunkier. It's hard to do $50 billion deals when once upon a time the industry was used to doing $5 and $10 billion deals. Do we expect to see more M&A in 2026? We do, but the deals will be infrequent because there's not so many companies out there to be acquired.
Let's talk about interest rates now. We know that the Fed is in the midst of cutting rates, and we can forecast maybe it's 1, 2, 3 for the year. But bigger picture, we have insurance companies have something called the float, and that's where investors pay in premiums, and then they can invest that money and make money off of that. And tell us about that dynamic and what the prospects are for the float and also interest rates, how they play into that.
So let's go back 2 years ago when the Fed started hiking rates to fight inflation. Right. All of a sudden, you had the ability to buy very short-term securities and earn a high yield on those. These companies mostly invest in bonds and whatnot. And so from the perspective of the float having great opportunity, they've already maximized their earning on the float probably a couple of years ago. And now that we're heading into a rate cutting environment, it's going to be difficult for them to earn more on the same float than they had in the past. Now, also, because they've been making a decent amount of money on the investing, it suggests they might compromise on price. And so overall, we can't say at any given moment in time that that's why there's softness in the insurance markets, whether it be property that's very soft right now, personal auto that's flattish right now, or casualty and liability lines that may not be rising at the same price as loss cost trends. But if you're an insurance company, say, gee, I'm making a lot of money on the investing. I've kind of already peaked out on that, but it's such a good return on the float at this point in time that I'm willing to take less of an underwriting profit in order to do it. So we think that 2024, 2025, it's kind of peak returns. You made a decent amount of money on the underwriting. You made a decent amount on the investing because you had short-term opportunities to deploy capital. But as interest rates roll over and there's less of an opportunity to deploy that capital, you may see that the float kind of returns the same sort of yield, while underwriting at this point may see returns that have been lower than the recent past.
Josh, that was a great explanation. Thank you. We got under a minute, so just give us your final words to investors, anything we didn't cover here for insurance stocks.
Well, look, growth is everything in this kind of market, especially a market where people want to invest in tech and software and all those things. Insurance is not really a growth field. There are some growing companies like Progressive, which has had a track record of growth that's phenomenal. But in general, the way that this industry behaves is both, again, to buy into the market and put more capital to work when you can earn excess profitability and to know when to pull the chips out. So any company that is always full steam ahead will ultimately lose in insurance. The key part is to know when to stay at the table and when to walk away. And so when you see companies returning copious amounts of money to shareholders, some people say, oh, that's a signal of lower growth. I want to pull out. We would say that's actually a sign of very responsible leadership in the sector. And ultimately, those companies who are deploying capital to work and then pulling it back are the ones who grow book value and returns for shareholders the most over the long term.
Kenny Rogers had a few words about that. You got to know when to hold them, know when to fold them, know when to walk away, know when to run. All right. Thank you for that. Great talking with you.
Take care.
Now time for some of today's trending tickers, starting with Rivian. The EV maker reporting fewer deliveries than expected for the fourth quarter. Deliveries also saw a double-digit decline from the previous quarter and a 31% year-over-year drop. While looking ahead to 2026, Barclays expects a modest increase in when assuming a slow ramp for the R2 model, along with a decline in R1 volume. And turning to furniture retails, those stocks are climbing after Trump's latest tariff announcement, the president delaying increased tariffs on upholstered furniture, kitchen cabinets, and vanities for a year. The higher duties were previously expected to take effect on January 1st. The move keeps September's existing 25% tariff, but postpones scheduled hikes to 30% for upholstered furniture and 50% for kitchen cabinets and vanities. And lastly, Vertiv Holdings gets an upgrade at Barclays, the firm lifting its rating on the stock from equal weight to overweight. Barclays highlighting that Vertiv is ripe for some catch-up in 2026, adding that shares currently offer a good entry point. Barclays saying there is substantial upside scope to current consensus estimates for both 2026 and 27. Vertiv has 28 buys, 6 holds, and 1 sell among analysts tracked by Bloomberg. And coming up, how AI can affect your grocery prices. Instacart recently coming under fire for changing the price you pay, but it wasn't alone in that move. We have what you need to know straight ahead here. U.S. shoppers may be in agreement on prices being too high for comfort, but what they might not see coming are pricing experiments. And thanks to AI, those experiments can become even more targeted. Consumer Reports Director of Technology Policy, Justin Brookman, joins us now with a closer look. Justin, thank you for being here. I read your report. Just lay it out for us. This involves Instacart basically charging different prices for the same item for different people, different parts of the country, and we're not even taking into consideration shipping costs, I'm assuming.
Yeah, that's right. We had heard some tips that Instacart was doing this sort of personalized, individualized pricing. So what we did is we've recruited a bunch of Consumer Reports members. We sent them all to the same exact store and said, hey, go shop at the Denver Safeway using Instacart, buy the same 20 items, and then we'll compare to see what you got at the end of the day. And we were really surprised that actually for the majority of items, we saw differential pricing between consumer and consumer, again, shopping at the exact same store at the exact same time for the exact same item.
And I'm wondering how prevalent this has been throughout history. I don't think it takes AI to produce any kind of algorithmic pricing that might account for different prices here and there. Is there any precedent to this? What's the backdrop there?
Yeah, this is something that's happened occasionally over time. I mean, Amazon famously in around 2000 got caught doing this for DVDs. Some people would get like, $23.99, some people $19.99. They got caught and they were embarrassed by it. They apologized, said this was wrong. And so researchers have been kind of looking for it ever since. And there's been a few examples here and there. But this was surprising to us, the extent to which they were, again, for so many products, for so many people, were charging different prices, as much as 23% difference for the same item. So some people might be getting Skippy for $2.99. Some people were paying $3.39. Some people paying $3.69 for the same thing.
Yeah, that's a huge difference. Let's talk about some of the companies involved here. First of all, Instacart has said that they're stopping the practice, but nevertheless, it was found that Target items were part of this survey or part of the problem here. And Consumer Reports says that you're saying that in your pricing experiments at Target told Consumer Reports it had no business relationship with Instacart, yet Instacart acknowledged scraping Target's public prices and adding amounts for costs. So what went on here?
Yeah, so I think there are some people who deliberately took advantage of software that Instacart offered and said that you can do this sort of personalized pricing. But again, you can go on to Instacart and buy through companies that they don't have a relationship with, and Instacart still would have the ability to set the prices themselves. And so in this case, Target said that they weren't involved, that it was all Instacart's decision. A lot of Instacart's clients said that they weren't doing this, that they charge the same in the store that they do for folks online. And like you said, since this all was exposed last month, Instacart says they're not allowing anyone to do this anymore. But again, this is just one company. As you say, AI is more prevalent now. We might start to see this in more areas over time. So that's why we're going to continue to do this sort of research, but also work on potential legislation around the country to the very least require transparency. But in some cases, maybe this should just be prohibited. This should just be one price that we can decide to pay it or not.
Yeah, really interesting there. Maybe we can circle back to the regulatory front. Just talk to us about the bigger picture on personal data and what we're talking about, surveillance pricing, and some of the things that you found and some of the trends in place here.
Yeah, I mean, people are definitely looking more and more at this, and that's the concern as a consumer advocate. If companies know more and more and more about us, they know how much we're willing to pay for Skippy. They know I'm more demanding. I'm more desperate. They're going to charge me more for it than someone else. And so for each transaction, if the company can take all the value, the consumer receives less of it. I think that's worse for us overall. Again, there is a goodwill cost when companies get caught doing this. I think Instacart saw like a 6-7% hit to their stock price, and it still has not recovered since the investigation came out. But it's actually really hard to find this sort of thing. We had to do a very long study and recruit a lot of people and make sure our methodology was correct. And again, more and more companies are going to try to slide under the radar and try to do this, especially in concentrated industry with only one or two choices. They have more power over people, so they potentially have more capacity to try to extract again the relative surplus from any transaction.
Well, I can appreciate the difficulties and the extent to which you, all the measures that you took to collect this data. I want to circle back to the regulatory front. You mentioned that you might be influencing some regulation here. Tell us the extent of that.
Yeah, so there's been some legislation introduced around the country. New York actually had a law go into effect this month or last month where they have to disclose if prices are changed algorithmically based on individual data. We've also seen legislation to just prohibit a lot of personalized pricing. It got pretty far in California last year. It's going to be brought back this session. We've seen legislation introduced federally as well. So I think we're going to see it in probably maybe a dozen states this year. Also the potential for federal. And also the Federal Trade Commission might get involved. I think the Federal Trade Commission said that they are investigating this practice and had some significant concerns about it.
We got time for one more here. Any other pricing discrepancies or anything that's been on your radar that you'd like to share with us here?
Yeah, I mean, the other factors that might be concluded, geolocation. There's been some stories that if you're close to a store, they might give you a lower price than if you're farther away and more desperate. There's been examples of companies based on IP address. They think you're coming from a richer city. Maybe they'll show you higher prices for hotel rooms or other services than like if you're reserving online from somewhere else. Reserving the same particular hotel. So there's more and more data about us out there, more and more capacity to leverage that. People are always looking for extra margin. And again, that's understandable. I totally get it. But from a consumer's perspective, I just want some degree of fairness, some degree of not exploiting information that you don't necessarily deserve to have to try to find out more about how much I'm willing to pay.
All right, we're going to leave it there. Really appreciate your investigation here and sharing the details with us. Thanks.
Thank you.
Time now for What to Watch. Starting off on the labor front, we're going to be getting a bunch of new jobs data throughout the week, including the December jobs report on Friday. Economists forecasting the U.S. economy to add 55,000 new jobs, while unemployment edges down to 4.5% and hourly wages tick up to 0.3% on a month-over-month basis. Ahead of the monthly jobs report, we're going to get the ADP reading on private payrolls. That is expected to show growth in December, 48,000 jobs added, signaling a rebound in hiring momentum following the longest government shutdown in U.S. history. And we've got some earnings to be tracking. We're going to be hearing from several names in the food and beverage sectors, including Albertsons, Cal-Maine, and Constellation Brands. Constellation announcing results for the third quarter on Wednesday. Analysts expecting earnings to fall sharply in Q3, driven by alcoholic beverage companies selling off big chunks of its wine and spirits business. And finally, the 2026 Consumer Electronics Show, or CES, is kicking off in Las Vegas. Nvidia CEO Jensen Huang giving a presentation on AI on Monday. AMD CEO Lisa Su is also giving a keynote address at the conference on Monday. And Yahoo Finance will have coverage from the event throughout the week, including an interview with the CFO of Qualcomm. You don't want to miss it. And that's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3:30 p.m. Eastern for all your coverage leading up to and after the closing bell. Have a great weekend.